Welcome back, everyone, to Vox Markets. My name is Paul Hill, and I'm delighted today to be able to speak to Abby Glennie of Aberdeen, one of the UK's finest small and mid-cap investors. So welcome, Abby.
Hi, Paul. Thanks for having me.
Yeah, well, given all the sort of like investor ranks currently on the markets with the cost of living crisis, rising inflation, tighter central banks, the ongoing war in Ukraine, and now in a week's time, we've got the potentially much sort of like austere autumn budget coming from the Chancellor. What's your sort of outlook for equities going forward?
Yeah, so I mean, this has obviously been one of the toughest years for equities. And I mean, it's absolutely been a year that's been more macro driven than, we've seen for a long, long time. And we've been doing a huge amount on trying to look at market timing and, outlook in short term versus sort of the long term, where absolutely over the long term, we've got a really positive view. I think the UK in most ways looks cheaper than it's probably ever been before, but, certainly for a long, long time. And within that, small and mid cap, looks really cheap. The lag between small and mid cap and large cap this year has been really extreme. And, that's been driven by particularly certain sort of sector biases in large cap in the UK, and also that general risk off trade. But, we do think when the market turns, we feel really confident about the sort of outlook for small and mid caps and how they can close that gap. I think the most difficult thing, and, we've been having lots of discussions with clients recently about it, is that market timing. I think when we look at past data, the problem is that data is only as good as it can be, and every single recession, every economic cycle has been different. So really the sort of best that we're able to get is an average of 5 cycles, which have all been driven by very different things. But it would show to us in the UK that generally the market doesn't turn until the worst point of economic pain. And I think the challenge that I have at the moment is that it still feels like we're some way off that. Now, that is a bit different in some other geographies. So when we look, we also run sort of European and global funds in the team. When we look at data from the US, for example, the markets tend to turn, it would suggest, earlier in the recession. So even maybe only 1 month into recession, you get the market turn. But the UK does look to be a little bit more delayed than that, I would say.
But given your sort of sweet spot of small and mid caps, I mean, I remember sort of like, then back to the 1990s and the 2008-9 global financial crisis, and small caps tended to turn faster than the large caps. In fact, I think in sort of back in 2000, I think small caps sort of like bottomed out in about 9 months before in the great financial crisis. And equally, it seems to be part of the selling in small caps seems to be exacerbated by fund redemptions as much as anything. Can you just sort of comment on sort of like that time between small and large caps, and sort of like whether we're seeing a sort of artificially low sort of like valuation in small caps because of this technical issue?
Yeah, so I think that sort of timing of small and mid versus large can be very different in different cycles, and particularly because if you look at UK large cap and even how well it's done versus some other geographies large cap, FTSE 100 in the UK is packed with oil and gas companies, staples, utilities, lots of these, a lot of the banks, are actually doing quite well at the moment. So I think that's where I think there's a bit more of a disparity in this cycle than in other cycles. And I think a lot of that turning point and whether small and mid cap leads that, we would say it definitely leads the market when it recovers. In terms of if it starts recovering early or not, I don't think there's that much clarity on that.
Well, I mean, one anecdotal on that is the amount of M&A. I mean, that's saying to me, smart money is actually piling into the sector and buying companies off. And if they don't, the management teams are taking them private.
Yeah, and I think that particularly, I would say earlier in this year, we had a lot of M&A, not necessarily actually in the portfolio, because I would say a lot of it was a bit more opportunistic for companies which had really struggled and were sort of on really bottomed out multiples. And we saw most of that being from private equity. I think there's been a change though in that private equity scene. If we compared the start of the year to now, just in terms of the capital that they still have to deploy, their eagerness to pay up for deals. I think FX has obviously been a big beneficiary in terms of companies being bid for, but it has slowed down a bit recently. We've still had a few, and I think particularly actually in the tech space, we've had a few, but some of them have fallen away. But I think, that was really encouraging to me early in the year in terms of showing that if the market wasn't willing to value these companies in the short term, someone else would. Your fund redemption thing's interesting. I think we've been really lucky. We haven't really seen outflows in the funds this year. And I think hopefully a lot of that has come from how we've sold those funds to clients over the long term. And we've always been very clear about our strategy, our investment process, and times that we will struggle in. And I think we've also done a lot of work in terms of the succession planning as Harry Newman retires. So it hasn't impacted us, but it definitely, we hear about it. So, I hear about it from companies actually. And, you never know if this is slightly, they're being fed this by brokers or not, or if it's reality. But, a few of us have mentioned where, they've been told of sort of forced sellers pressuring shares down.
Yeah, I think there's definitely anecdotal evidence on that, because you get good quality companies knocking the ball out the park, and they get obviously some buyers in the market, and that's the ideal opportunity for fund managers to take a bit of cash off the table and redeem. And I think you're seeing that is that you can come with companies who are doing really, really well and growing strongly, but their shares drop on the day of the results, and that just shows me that there are fund redemptions.
Yeah, and I mean, we talked about that stock irrationality that we were seeing, and I would say that was more dominant in the first half actually of the year. I think it comes and goes at the moment, but absolutely, like, we found it really, really frustrating because we've got a number of companies who are continuing to see earnings upgrades, and their shares have been really, really strongly derated. And I think there's elements of fund redemption on that. I think there was a lot that was sentiment driven and style driven this year. I mean, absolutely, brokers clearly are aware of funds where there are strong redemptions and stocks that are dominant in those funds, and there's forced sellers. So there is definitely that going on in the market, which isn't helpful, and particularly in small and mid cap because of the liquidity and how quickly it can impact. Sometimes all you need is one forced seller, and it's a big overhang.
Yeah, well, hopefully in the fullness of time, that will all sort of clear out and we're back to the races. Now, I did notice you've got a couple of sort of like really astute buys of late. And one of them's Alliance Pharma, which is an OTC healthcare products business, pretty defensive. And actually, I was just looking at, the shares are very, very cheap. They're trading at sort of like less than 10 times sales. Do you want to take us through what sort of attracts you? I guess M&A as much as anything.
Yeah, so Alliance has been a tough one actually since we invested in it, in that we absolutely bought it for the reasons that you said. We thought it was in a defensive space, and would be really resilient through this environment. A lot of their sort of, it's like small ongoing product sales, but they've had a couple of challenges which have disappointed us. But we think they're very short-term challenges, and actually, the investment case for the long term isn't changed. And some of those have been around sort of the Chinese situation, which actually, in general, so they had challenges in terms of the COVID shutdowns, lockdowns, and the ability of their sort of cross-border distributor to sell products. So that's been a negative for them there. And we've also seen them have a couple of challenges with some of their other products. So that was particularly around the scar cream that they distribute. One of the other things which really hit shares was a CMA investigation that's been announced, which I just think has been really badly communicated. This was a sort of anti-competitive pricing thing from, I think it's from 2013. It's really out of date. We don't think that we've spoken in depth to the company about it. We think that it will be resolved in a very reasonable manner. But I think the challenge is that, for a company that everyone thought would be defensive and wouldn't disappoint them, that sort of any point of bad news or worry has really sort of impacted shares in the short term.
What in terms of, it should have a sort of strong recurring revenue stream. It's got brands, obviously, with pricing power that it can push on. So it ticks all the boxes. But I just noticed, obviously, it's gone through, done a few acquisitions. I think the Scar business is obviously, they've bought into that. And they've got about sort of like 2 times net debt to EBITDA, which isn't historically that much. But in a rising interest rate environment where refinancing can get a bit tougher, particularly at higher rates, how, just more broadly, when you look at sort of companies, how do you view that, especially if the E or the EBITDA ever falls away, because you become a real problem.
Absolutely. And it's definitely something, so like strong balance sheets and cash generation is a big part of our focus. I think that what you have to pay attention to is what net debt EBITDA is suitable for each type of business, because it can be very different across different sectors, you know, different revenue visibility. So for them, I think 2 times is manageable, but it's definitely the upper end of where we'd want to see it. You know, actually a lot of our businesses are net cash, and I love that in any period, but particularly at the moment, I love that. And the other thing that we see as well is just the advantage that they have relative to peers by having strong balance sheets. It allows them to continue to invest, perhaps continue to acquire, when actually their peers with worse balance sheets might well be struggling. And I think some of the sectors where that's most relevant is things like retail, where there's a lot of companies who have survived for years on cheap debt. And actually it's in times of market opportunity, people take share. You know, I think Dunelm's a really good example of that, actually. You know, they've gone from strength to strength while other peers have really struggled. But we have been having a lot of discussions with companies about, I sort of laugh, but I say, you know, 1 times is the new 2 times. You know, when shareholders used to feel comfortable at 2 times, just take that expectation down at least half a notch.
Particularly when you're going to if you go into a tougher times and your earnings and your profitability decrease, then clearly you 1 can become 2 as well, can't it, afterwards?
Completely. Yeah, exactly. And you know, a lot of them, you know, I guess sometimes management teams think, look, but here's our covenants, we've got lots of breathing room for that. But I think the important thing for them to understand, and where we do a lot of discussions with them, is it's the sentiment aspect. So it's, what do shareholders think though? And what will the reaction be when your net debt EBITDA is on a sort of less manageable level, let's say, with risks around it? So so there's the competitive aspects, but there's also the sort of sentiment, and then there's the true earnings impact. So another thing I've been trying to do a lot of work on is just looking at what of the companies with debt, you know, what's floating rate, what's fixed, when does it need renegotiated, and you know, are there any sort of concerning points around that?
That's a really, really good point, and I'd say I highlight to investors, just if you can get a sort of like a really sort of focused lens onto their balance sheet and interest payments, it makes a much amount of difference in terms of the risk profile. And just turn into another one, coats, which I think is sort of like an old sort of like a industrial threads business. But can you take us through what sort of like, you know, sort of piqued your interest on that? Has it got IPR or what?
So Coats is quite a reasonably new investment for us. We took part in it when it did the placing to do a German acquisition. And you're right, Coats has been around for a long time, but really I think the investment case has evolved and improved over the last sort of year or so, really. And what we see is they're a market leader essentially in thread for manufacturing. They've got really good market share. And I think under this management team, they've really taken the business forward in a number of ways. So actually one differentiator for them is what they've been doing on sustainable cotton and sustainable thread. And they're really the leader in that part of the market. You know, if you just need to look at any retailers, clothing retailers, to see the sort of pressure that we're seeing in terms of making more sustainable clothing. So I think they're really leading in that. You know, I think also they've done a huge amount in terms of operational improvements in the business. So, you know, we've seen some actually exits of sort of non-strategic parts of the business. We've seen, you know, real product strategy coming through, a lot of self-help, we still think, on margins. So I think they've probably doubled their margin already over the last few years. And I think there's still more to go to on that. Right. And then, actually the acquisition that they did in Germany, that was really to enhance the footwear part of their business. So they had a small amount of footwear exposure, but actually this now really brings them a leader. So I think now they have a 20% market share in that business, and they've pulled that out as a separate division.
Does this give them the pricing power? Because I mean, I was just looking at their margins, and just as you sort of talked about it, and EBIT margins are 15%, which seems incredibly high for a sort of like a thread manufacturer.
Yeah, and I think that's an interesting thing, isn't it, when you look across different sectors? I think they do have some pricing power, and I think that also comes through. It's not just about having big market share, it's about what you're doing for customers. So it's about having the leading products, having what they're looking for. Also, what Coats do really well is, because they're global, you know, they're able to satisfy people in all different geographies, and also position themselves close to where the customers are, which is really important. And also, I mean, we see a bit of that if you look, maybe the US is the best example, the kind of nearshoring trend. You know, I think that'll be a positive for them. But those margins feel sustainable. Like I said, they've probably doubled, you know, over the past few years. I think they were sitting down about 7%. Now I think they're about 14. You know, forecasts assume that those improve a bit, and we think they can improve that and probably a bit more. And a lot of that comes from that self-help elements as well.
Right. Yeah. I mean, I'd definitely point investors to have a look at Coach. It's been around for 100 years and trades on at less than 10 times EBIT. So, sorry, price earnings ratio. So it's pretty cheap, and it's obviously showed its resilience through thick and thin. Yeah. Now, another one you've recently bought is Paragon Banking, which I think is a buy-to-let lender and also sort of like specialist business lender. What's the sort of thesis behind that? Because obviously the housing market could potentially take a backward step. Yes. And that may impact the, you know, sort of landlords and also sort of businesses, etc., going forward. So what sort of? I know it's cheap.
Yeah, it is cheap. And that's generally never a reason that we buy a company alone. You know, that's not our style. We're not value investors. We have to think these things are quality growth businesses. And we have actually owned Paragon before. The other stock that we own in our mid-cap fund is One Savings Bank, which is a very similar investment case to Paragon. And I think where these businesses, just for people who might know of the history of them, your Paragon did struggle a bit in the global financial crisis, but really their challenge there was about their funding model. So they were very dependent on the securitization market, which, you know, essentially fell away almost overnight. And that was a real challenge for them. Now, the business now is actually really focused on retail deposits. So it has a banking license. And so they're really able to step up that retail deposits if they want. And actually, in general, you guys, these companies, they benefit on the sort of net interest margin because they take a lag in terms of passing it on. And what we saw with Paragon is actually that, like, their credit quality was incredibly good right through the global financial crisis. And if you look at the sort of impairment levels, and, you know, I think what they do, that both them and One Savings Bank, is when we look at the stress tests that they assume in the model in terms of interest rates, unemployment levels, all these things, you know, we felt like actually there's a huge sort of margin for error of those things worsening before it becomes a problem for the business. Right. The buy-to-let area is still pretty healthy. You know, it's kind of dominated now, and that's their focus, is those sort of semi-professional buy-to-let investors, you know, who have a sort of handful, let's say, or so of properties. And we've also improved a lot of the sort of credit work on the back of that. So in terms of being a receiver of rent status, for instance, if things do go wrong with one of the lenders, one of the borrowers. So yeah, we think absolutely, like, sentiment wise, you know, things are not exactly buoyant, let's say, in the housing market at the moment. But also, you know, I think the demand for rent, because there is a lot of people who unfortunately are probably going to be on the rental market for longer, is really structurally still there as well.
So you think the credit quality should hold up in through sort of like if we just have a moderate? I did see Lloyd's a couple of weeks ago putting out that it reckons it's a peak to trough decrease in house prices of roughly around about 10-11% over the next year or so, and that you think that should be fine for something like Paragon?
Yes, I think, you know, I think there will definitely be areas of housing price pressure, but I think actually in terms of, you know, what matters to Paragon is, you know, there's a bit of loan book growth, you know, in there, but actually a lot of it is around the loan book they already have and the credit quality of that. And I think you especially you know, on less than 7 times PE, you know, I think you aren't assuming greatness or real improvement in markets in that valuation, I would say.
Yeah, and they're trading at about a 10% discount to net tangible assets. So it gives you a fair sort of sub margin of safety. Now,
really good capital generation as well, and good returns.
Yeah. Another, just to turn into sort of running your winners, Ergomed, which has absolutely done fabulous for you. It's sort of like a contract research organisation to the large pharmaceutical sort of companies running their sort of phase 1 to phase 3 trials, plus some testing, I think, after once a drug has actually hit the market, etc. In terms of, there's a couple of questions, I guess. Well, first of all, what sort of, you know, what do you really like about the business? And secondly, in terms of, given it's done so well and and I think it trades on roughly around about 21 times EBITDA for a contract research manager. What point do you decide to sort of like, you know, to maybe top slice a position?
Yeah, so I guess firstly, you know, the focus on Ergomed. So I think they really have not put a foot wrong since we've invested in that business. And absolutely, there is a bit of volatility in those markets, probably more sentiment-wise than actually for them. So I think a lot of the chat you hear around the continued sort of investment and growth in those markets has been volatile because of COVID. I.e., you know, actually there's a lot invested in, for instance, COVID trials and COVID drugs, and that's obviously coming off a bit. But actually for these guys, they really focus mostly on oncology and rare disease. So they, you know, and that's a deliberate decision. You know, they structurally believe in these areas. And I think one of the things that I really like about Ergomed is actually the revenue visibility they have because of the sort of recurring nature of these trials and the pharmacovigilance part of the business, which is sort of really around drug safety. So, you know, I think they're going into a year, maybe about 80% revenue visibility. And that gives us a huge amount of support on that. Now, I think your point on running your winners, you know, and valuations is absolutely part of our process. So we do run our winners, you know, particularly where we're seeing that the quality of the business is still there, but that earnings upgrades are still coming through. And earnings upgrades are definitely becoming a rarer recurrence in the market at the moment as well. Okay. So I think the value of those as such, particularly where we really believe in it. And I think for Ergomed, we've seen them also do acquisitions, you know, to get more of a foothold in other geographies. You know, I think they'll continue to expand into other geographies. I think they've already built up a lot of the underlying relationships that they need for that to succeed. So, you know, if we look out a few years, we see more to come from that business. In more general, in terms of how we think about sort of valuation, you know, it's absolutely a part of our process. But in small and mid cap, we do, you know, in many ways think that you get what you pay for. And actually, the sort of cheap value stocks, you know, we think are actually at risk, particularly if you go into recession. The nature of these businesses and what they do, I think that they are going to be the ones who are more of a focus of earnings downgrades in a recessionary period. Now, the question is, how long is the recession? You know, the Bank of England said last week, didn't it? It's going to be a really tough 2-year recession. And so that gives me a bit more comfort in actually being happy to continue to sort of pay up perceived higher multiples for companies, particularly where I think that E in that is wrong. You know, I think that earnings are going to be higher than forecast. I think is absolutely, it's kind of, it would definitely be one of our much higher rated businesses. You know, we've seen a lot of our other growth businesses really derate on sentiment this year. So actually a lot of them are not pricing in much, we don't think.
No, I think you raise a really good point on Ergomed, because I was looking at the margins, and it does about 16% EBIT margins, which actually is quite low for a CRO across the industry. So there must be opportunities to squeeze the lemon a bit more and sort of take some of the cost out and leverage the economies of scale. So I think you're exactly right, actually. There's some operating leverage which can happen through that business and drive the. Now, you raise a really important point in terms of, and I'm going to give you a tough one here, but investors are really going to, you know, will benefit. How do you identify between a sort of like a value trap and a value play then on the more sort of like the cheaper segment? Because that is a head scratcher for a lot of people.
Yeah, and actually, I think the funny thing that we've struggled with a bit this year in terms of discussions is that people want to put, you know, value bucket here and growth bucket here. And actually, how a lot of investors play is they want to hate one and love the other. And I think one of the challenges we've seen when we've been looking at a lot of data is that actually a lot of our real growth businesses, which have not disappointed this year, have been so heavily derated, you know, they can probably sit now in a growth bucket and a value bucket in many ways. Yes. And I think that's the interesting point for me on the market recovery, is that where people would traditionally think that gets led by your more cyclical value bucket, actually, you know, a lot of these growth businesses are cheap relative to history, actually not that much more expensive than a lot of those more cyclical sectors. And that's where I think there could be an opportunity for a lot of those things in a recovery. On what's a value stock versus a value trap, and you know, I think the key thing that we kind of look for is it's not about a distinct PE multiple, EV/EBITDA multiple. And I think every business in every sector, in every market cycle, has different levels for that as well. I think what's really important is it's the quality of earnings. It's the revenue visibility, it's the strength of contracts, it's the how cyclical they can be. And particularly if I look at companies as well, where absolutely they're cyclical, but I still think they're quality growth. A lot of it also comes down to the management team and what I think they can do in a tougher time. So maybe a good example might be Marshalls, which is sort of best known for block paving.
Yeah.
They are absolutely having some pressures in the residential side of their business at the moment for obvious consumer reasons. The infrastructure part of their business is continuing really strong. But one thing about them is, and I look at what they've achieved in the past, and then we talk about all the operational changes they can make at the moment. I think they have a lot of flexibility in terms of what they can do in manufacturing and operations to control margins, even despite pressures. And I think that's what's key. For me, it might have cyclical elements, but I absolutely don't think it's I think it's more in control of its own destiny, let's say, than some other cyclical names. Yeah,
and I think another one is in terms of the cyclicality, but also having a secular theme driving it, isn't it? In between distinguishing a value play and a value trap. Now, just on that sort of like on Marshalls and the wider sort of housing sector, we've talked about sort of like Paragon as well, but another one you own, I think, is brick builder brick manufacturer Forterra.
Yeah.
So, do you want to sort of touch on how you see? Because the housing market, the building products industry, ACCA, sort of like Marshalls, and it's come off so much. Marshalls is trading at about 8.5 times PER. Admittedly, it's got quite a bit of debt, but Forterra's got a rock solid balance sheet and trading on the same multiple.
Yeah, and Forterra, it's actually a business we own more in the income trust that we run. And yeah, I think key for Forterra is that it's the volumes of housing. And what's interesting about the UK is that we've been on a huge shortage of bricks for years. Yes. And actually, it's kind of, the market's dominated mostly by Ibstock, which is also listed, and Forterra. And I think both are acting in a disciplined way in terms of capital investment and new capacity. And new capacity tends to always be more efficient as well. But one of the things is we import so many bricks to the UK, more than ever. So I think about 30% of bricks used are imported at the moment from Europe. And in terms of, the cost of those has just got even worse in terms of logistics. And on an ESG side of things, it's not the most favourable in terms of the additional...
and the currency.
Well, the currency as well has made them more expensive. So I think in any market downturn, I think those are the first to go, is the imported. Now, there is a lag because once you've started a house building site, you don't swap the brick. So absolutely that doesn't happen, straight away on month one. But as you cycle onto new sites, I think that those are the imports. They're the expensive ones and they're going to go first. Yeah. And actually what we're seeing with Forterra is, as an investment case, I think they have been selling, they've got really low inventory. They've been selling every sort of brick that they can make. They are investing in capacity in a really disciplined way. Actually, and the thing people worried about for them, and they don't just worry about the housing market, they worried about energy, because kilns are incredibly energy focused. But they've actually got quite good visibility. They, certainly through this year, but even into next year, of what they've been able to hedge on energy. And actually, they've hedged particularly the first quarter and the winter time. So the part of next year that they're not hedged is summer, which you would hope in terms of the sort of seasonal element is less of a risk for them.
Yeah, and the UK historically has always been well below where it needs to get to in the house building. It's struggled to do 200,000 new houses each year, and it needs to hit 300,000. So we need more, basically more.
Exactly. And that's what they use. And the other thing is pricing power. Like you talked earlier about another business. Pricing power is so important in these sort of industries where you have cost inflation. So Forterra, since the end of last year, I think they've put up prices on bricks by 30%.
Yeah.
And, they're able to pass that on. The cost of bricks within a house build is actually very, very low. So house builders are able to, they kind of have to
take
accept
the cost,
but they're able to,
Yeah, and I think Forterra is London Brick is one of their biggest brands. Is that right? Which is just synonymous with the southeast, isn't it? Because you've got all that brilliant sort of like Victorian and Edwardian properties done in London Brick.
Yeah, I learned a lot from Forterra because actually I live in Scotland, and actually we make a lot more timber frame houses here.
That's right, you do, don't you? Yeah, okay. Now moving on to another sort of run your winner stock is Kainos, which is I think effectively a digitization IT service provider to the public and the private sectors, and they've been knocking the ball out the park. And again, it comes down to the other question: at what point do you sort of take profits, particularly if it may be perceived as being a bit of a sort of COVID winner, as people have sort of like cloudified their operations? But what's your sort of latest sort of like thinking on it?
Yeah, so we've owned KNOS for years, ever since IPO actually, and it's been a fantastic stock for us, and it's really evolved as well because it's moved out into not just government work but into corporate work, and they have a really strong relationship with Workday as well as an implementation partner, which is getting better and better and more global.
Is that an ERP platform, Workday? Is that it's corporate? Workday.
Exactly. So it's a listed US business, but it's essentially for corporates across all sorts of sectors would utilize that as their sort of ERP HR type system. Yeah,
that's right. Yeah.
So what Workday do is they have a very sort of selective list of implementation partners in different geographies, and that's part of the KNOS business. But where people worried about KNOS earlier this year, I would say, was around margin pressure from actually, it's a people business. So, most of their cost is people, and around the ability to find enough good people, firstly, for growth, because they're growing fast, but also, the wage rise pressures of that. And I was actually over in Belfast, so, went to see Brendan, the CEO, and we had a really good discussion around it. And the key for me was demand. When demand can remain strong, they are able to pass that on. And, that's what we discussed. He said, when I open the door, work is flooding in. And actually, even from, that would have been a discussion we had in February or March. I think that's still really true. And I hear this from a lot of the other tech businesses we own. So things like Softcat, for instance, or Bytes, that digitization is just a continued structural trend. And actually, it's really interesting talking to some of them about how little maybe corporates actually have done through COVID, and actually how much people have sort of sat on their hands a little bit to make decisions and investments once they had more clarity about the sort of future of the business. So for KNOS, I think actually demand's still really strong. Where they sometimes get a bit of pressure is around the UK government budgets tend to be around, I think it's 3-year cycles. So you just get a bit of sentiment around the end of that.
Right.
But actually, I think there's a stream of continued digitization. And don't forget, these projects are cost savers. So they save the government money in the end of the day, or corporate money. And on the Workday side of the business, I think anyone can obviously see Workday growth. It's a listed business. But importantly, I think KNOS are taking market share within that as well. And I think their opportunity in new geographies is key. And they've really invested behind that business. So I think their relationship with Workday is really strong.
Yeah, I think that's probably given it the premium, actually, because I was just thinking, when you look at something like Accenture, for instance, it trades on about 16, 17 times EBITDA. And I did notice that KNOS is on 21 times. So it's slightly higher. But yeah, if the growth is a lot stronger, then it obviously justifies that. Now, another one is Alpha Financial, which I guess, being in the industry, you probably know a great deal. I mean, I think it's sort of like an IT sort of platform that services all the sort of fund managers and IFAs across the industry.
Yeah, so this one's Alpha Financial Markets Consultants. It's become confusing because there's so many alphas.
Yes, you're right. Yes.
So yeah, and you're right. When we first invested in this at IPO, actually, I think Aberdeen was one of their biggest customers because they did a lot of work for us through the merger. Right. And they service, I think they service all of the top 20 global asset managers. And this is a founder-run business. So it's one thing we really like is founders. I think, not every founder is equal, but absolutely, where we have had a lot of success in founder-run businesses, and particularly the culture that they create, and in people-based businesses, that is so key. So yeah, I mean, I think Alpha has absolutely thrived in the asset management space in the UK. And there's a few reasons for that. I mean, I think it's their market position, it's their culture, it's their skills and how they've invested in the business. But I think as well, it's the structural challenges. So there is continued consolidation, there is continued regulation. ESG is just getting more and more of an ask from people. And so, you know, that demand is just continuous. But what we've also seen about Alpha is that they are proving quite successful in doing something that we really like businesses to do, which is expand into adjacencies. So what we've seen from them is they did an acquisition of a company called Lion Point in the US.
Yes.
That really took them into the sort of alternative space. We've also seen them expand into more of the sort of insurance market as well, which has the same structural drivers. So what was the challenge, I guess, was we wanted to ensure that we thought they could take this sort of culture, and because not every, you know, lots of businesses thrive in the UK, try and take it abroad and fail desperately. So that was our real challenge for them, was whether they could succeed at it and were they doing it in a disciplined way. And actually, when they acquired Lion Point, that was one of the key things we spoke about, was, you know, they thought it was an absolute fit for them in terms of the type of people, the type of work, the type of relationships. And
they seem to have a rock solid balance sheet. In fact, just on the valuation, yeah, exactly. I think on the valuation, when you strip out the cash, they're trading on around about 10 times EBIT, which frankly, for a consolidating sector is, it sounds like a bargain to me.
And I think that's right, though. You see, you've mentioned valuations a few times. Balance sheets matter in those valuation metrics. So, you know, particularly, we talk a lot about PE multiples. But lots of our companies are net cash balance sheets.
Yeah.
You know, and people compare them to peers or sectors that are maybe 2 times net debt EBITDA, and it makes a big difference.
Yeah, and I mean, another one with the rock solid balance sheet that's helping consumers around the country on the cost of living crisis is Telecom Plus, which does, I think it's utility warehouse, isn't it? Yes. And it sort of offers a selection of sort of broadband energy savings and insure all kinds of different sort of like utility bill sort of savings, doesn't it? Do you want to take us through that? Because again, that's done really, really well of late.
Yeah, it's been a great year for it. We've owned Telecom Plus for years. Sometimes there's bigger percentage positions in the fund. That had reduced, I would say, over recent years. And really, we've bumped that up again the past year or so. So it's really one of our top holdings in a lot of funds now. And so it's exactly right. So what they do is they are a multi-utility provider to households across the UK. And actually, their sales model is really direct sales. So, you know, it's more of a sort of friends and family, door-to-door sales type mechanism.
Referrals.
Yeah, exactly. And it's worked for them. You know, we've had lots of discussions around the positives and the negatives. Now, one of the good things at the moment is that those salespeople are really incentivized, because for a lot of people, this is often a like second income, a second household income. And they couldn't really do that role in COVID. So actually, after 2 years of not really being able to get out there, you know, really they're back on the front foot again. So I think that's helped the growth. But I think one of the key things is also what we've seen happen to the rest of the sector. So one of the key parts for Telecom Plus is that they have this long-term relationship contract with npower, where they buy energy at a set margin discount, essentially. And when we had all of those energy providers who were buying in the spot market years ago and offering consumers really, really low prices, that was really tough for Telecom Plus.
Yeah.
But those companies have now all gone bust, basically. And also Ofgem, some of the changes they've made in the industry, because they've learned from that. I mean, those companies are never going to exist again. We can't suffer that again as a country. So now Telecom Plus, because of that contract, they're in a really strong position in terms of pricing, in terms of market share, and then the cross-sell capabilities that they can provide for customers.
Yeah, I think they've got a winning shout at the moment. They're saying that their customers can save £125 off the sort of even the fixed price bill that the government is saying of 2,500, you know, put on when you do it on a unit basis. So I think they're getting people coming in droves, aren't they? I mean, it's a great shout.
Get yourself signed up, Paul.
Yeah, I know. I should have told my wife. Unfortunately, we got sort of like thrown in to Eon, I think, from a cheaper provider who went bust. So I think the light went out on bulb for us.
Yes,
so,
exactly. Yeah.
we regretted that. Now moving to some sort of fallen angels, actually. Focusrite, which does sort of like audio and sort of like software and hardware products for sort of like, you know, streaming, etc. And it was obviously did really, really well during the pandemic as everybody was locked down and wanting sort of content online. But again, I mean, it's got a pretty good balance sheet and trading now at about 14 times price earnings.
Yeah, so Focusrite is you're right, it's all about content creation, and I think that's the thing though I would argue is structural. You know, so yeah, it did well in COVID, but it's a bit different. It's, you know, I would say it's sort of semi-professional, serious hobbyists, and also actually sort of professional organizations. So you know, we could easily be sitting with some more advanced technology here today.
I would agree.
Yeah. So I think actually it's more on that side of things than I think it is, you know, entirely sort of a consumer type play, and it's really global. And also they have different brands across different price points, which is really important. So, you know, they can appeal to everyone, they can then trade you up, and also, you know, their products work really well together as well. The thing that has actually hurt Focusrite this year though has not been demand really. So actually demand's been good, revenues have been good. It's been supply chain really, and some cost pressures. And that's the thing that I think, actually, if I'm honest, I think they probably did all right for longer than I thought. You know, I thought, like, how are they managing these challenges in supply chain so well? And then when we had the last update for them, you know, they did have some downgrades because they got hit on that. But absolutely, like, the challenges they're seeing, we think are pretty short-term in nature. And, you know, we still believe that the sort of long-term investment case hasn't changed for this business. It's another business which does interesting sort of bolt-on type acquisitions, so complementary products and brands.
I think also you have all these, say, mum and pop semi-professional people who will go through an upgrade cycle. Actually, once it hits the price point, I think you'll get a lot of people who decide, actually, yes, it's fine at the moment, but I want something a bit more sort of like, you know, sort of Bloomberg or CNBC sort of type to be able to you know, to publish it online. And so they'll eventually move up. You will get benefit on the upgrade cycle. Now, another one which has done brilliant. I remember this stock is GB Group, etc. Now, I remember this at the start of 2000, and the shares were at 20p at one stage, and obviously they're about, well, nearly just out of the £4 at the moment, but they went a lot higher, and then they've dropped back down. But basically, it does ID sort of like verification for sort of protecting people against cybercrime, and also age verification and location and stuff like that. What's the sort of like the thesis currently on the company?
Yeah, so GB Group's had a tough time this year, and it's absolutely, so, you know, it's a global leader in what they do, so sort of ID verification, fraud work. And what's interesting about the business is it's like every sector it sort of touches, and that can be a good thing and a bad thing. So it creates diversification, and that was actually quite good for them in areas of COVID. So let's say retail and travel and leisure fell off, but other areas thrived. The big
crypto, I guess, crypto would be massive, and also online gambling would be massive as well, and markets, I suppose. You know, just normal equity markets.
Absolutely, and that's been a challenge though this year is crypto. So they were a business which did really well on crypto. They did pull out. You know, during that period, they pulled out. Like, we're doing really well on crypto. You know, this is a new thing, and there was definitely some risks around that not being sustainable. But this year, crypto just hasn't existed, because essentially where they play in this is around new customers. So it's about authenticating new customers. It's not necessarily about trading. So selling crypto isn't that helpful for them. So really they've seen their work on crypto just decline and decline. And I think the biggest challenge for them, and this is a bit frustrating because this is why they haven't just had one sort of poor update on crypto, they've now had two, is that I don't think they really knew what the base level of crypto would be. You know, so it had fallen off. They sort of said, look, we think this is the base level. Actually, we're now at a new lower base. So that's, and the challenge is that, look, that has, it's disrupted from the rest of the business, which has actually underlying been trading really well. Now, this is one of the UK companies, though, which has been approached in terms of being acquired. So we've seen that bid actually fall away again, but I still think it's probably in play either from that purchaser or from someone else, because I think it's quite a unique global asset trading on pretty cheap discount now with, you know, actually a lot of underlying strength in the business. And to replicate this business would take years and years and a lot of investment. Yeah.
Yeah. And I think also with the sort of the shift to online gambling and sports betting out in the States, which is just massive. I mean, it's big already, but it's a gradual transition. I actually think it should benefit them as well, sort of age verification and people verification out there, as you get a huge lift of that whole market, I would have thought.
Yeah, and that's it, you know, and I think they can diversify as well. So when they see new market opportunities, they can absolutely move into those as well. So the data is applicable, let's say, across the board. Yeah. Now, the final couple of sort of like, well, the fallen angels is in the food. We've got Hilton Foods, which I think came out with a slight profit warning yesterday on their UK seafood division, and Cranswick, which basically does sort of like fresh food, fresh poultry and stuff like that. And questions for both of them, I guess, is that yes, they're doing staples. Obviously, everybody wants food, and they're suffering from inflation. So I'm not sure how that's infecting them. But in terms of their brand and being able to pass that, we talked about pricing power. How resilient are these two guys in terms of being able to push on their costs into, you know, to their customers? Yeah. So both are similar and both are different in a way. So the thing that's different from history, I would say, is that both businesses have much better contracts in terms of quality with retailers. So if you look back sort of 10 years, actually they didn't have good mechanisms for passing on cost inflation. And those are now much improved across their businesses. Slight differences, I would say, are that Hilton tends to play in sort of beef and salmon, which are higher priced proteins. Cranswick more in pork and chicken. Lower price. So actually that's where some people are looking at the moment, is just that consumer pressure and what sort of trading down we see in impacts. What has been the challenge for Hilton is that they do have contracts which pass on the inflationary pressures they're seeing. And they've been able to do that in the sort of beef parts of their business. Hilton's also a much more global business. But the challenge they've seen is in the, like you said, is in the seafood, and particularly salmon in the UK, which was a business that they acquired. So the biggest problems have come from Sea Chill, which they acquired a number of years ago. And there's two challenges really, I would say, for the business. And both I think are short-term in nature. So one is just salmon prices rocketed. So through the year, they absolutely rocketed, way more than any other protein category. And you know, that was going to be a challenge for retailers to absorb all of that, and also for consumers to not, you know, just cut volumes on the back of it. So, substitution. Go to your tuna and your mackerel. So that's where, you know, I think as a business as well, they've absolutely passed on a lot of that, but you have to understand the relationships and the long-term potential impacts on the business. The other thing, though, I think for them is that what I've learned about the business is that they have a number of sites which are single customer, but in the seafood business, more of the sites are multi-customer, so they're for a number of different retailers. Now, where you have a single customer site, I think it's much, much easier and clearer, and the contracts are simpler for passing on every cost that's related to that. The challenge that they've had, that I spoke to them actually yesterday after their downgrade, is that in these multi-customer sites, there's far more ability for retailers to push back on what extra energy costs, logistics costs, packaging costs they should really stomach. So I think that's a thing that needs to evolve in that business. Cranswick, actually, you know, I feel more secure about them. You know, I think what they've done really well is I think they moved very early this year in terms of price increases, also to protect the pharma industry in the UK. But they also have really hedged out. So I think they've hedged out energy costs to 2025. I think what they've done over recent years is invest a lot in automation. So actually they've been less impacted by the sort of labour pressures this year. So I think they're in a pretty strong place. And you know, if you worry about consumer trading down, they're probably in the more affordable, let's say, proteins. And do they have their own brands at all, Cranswick and Hilton? Because I did look at the Hilton's revised EBIT multiple, and it's less than 2% actually, which tells me that they haven't really got that much sort of like, you know, strong pricing power. No, so most of the businesses aren't really about brand. So they will, in all the businesses, you know, they'll make your, I shouldn't probably name retailers, but they'll make your premium sausages from X retailer, your premium chicken cuts, your
so it's distributor own brands then, basically.
It's essentially, yeah. Where they do have some more brands is actually for Hilton in the seafood category. So that does have some of those better known brands on the shelves would be Hilton. But yeah, I mean, it's not a high margin industry. You know, your customers are retailers. Food retailers. Yeah, multiples. Who survive on really thin margins. So your margins are a lot better than them, but it is a business you need scale. You know, Hilton, for instance, now in terms of global, and their capabilities are really applicable geographically wide, protein wide.
Well, Cranswick should buy Hilton, in my view, because it'd be a cheap one for them to do, and they could put their best practice and lift the margins with a bit of luck. But that would be.
They're a very disciplined management team, so both of them actually. But in terms of how, I think the one thing about the food industry is there's so many of the private businesses that have struggled for years. They've got bad balance sheets, bad product quality. Ever since the Horsegate scandal years ago, product quality and governance is so important. And that's where these two, I think, thrive versus lots of the rest of the industry.
Yeah, certainly food security and being able to know where your suppliers are, then I totally get it. I guess now we've gone through obviously a few companies, a few interesting stock ideas, just sort of global sort of macro things you're looking at in terms of potential, I don't know, black swans or risks. Is there anything that investors should sort of like look towards? Should it be sort of, I don't know, the credit markets, or should it be, something else, which one of the bank, I mean, Credit Suisse has obviously had a few problems, or shadow banking sector. I mean, what's sort of like is keeping you awake at night?
Yeah, so I think there's always a risk, isn't it, that we get something more rogue that we haven't all thought about. But I think for me, it's just the key aspects of, inflation trends, interest rate expectations, and importantly, so the big questions for us are around recession, depth, harshness, length, and about the sort of earnings stability of our businesses. I think one of the things that we've been looking at is actually, markets do often recover quite quickly. So we look back at all the previous market turns, and I think sort of the longest was about 28 months, I think, to reach a new high. I think the 1970s inflation period was 33 months to reach a new high. But some of these numbers are in the single digits of months. So when markets turn, they can do quite quickly. I think, I saw some interesting work actually from Investec last week looking at the correlation of FTSE 250 and peak interest rate expectations. And I think it was a piece of work I hadn't seen before, which was really interesting, but also it sort of showed me, it highlighted to me, it's the understanding and the uncertainty that's really key at markets at the moment. So it's not just the pathway of inflation or interest rates, it's how those are relative to everyone's expectations. So if we know where we think interest rates are going, as long as they don't go higher than that, I think that's already built into a lot of sentiment. I think as well, I think a key for market sentiment will be inflation coming off from, these current levels. The thing that makes me a bit more nervous is I've done a lot of work on earnings downgrades. And, we're definitely in a pathway now of net downgrades, so more downgrades than upgrades. I've seen the US really catch up on that. So the UK looked bad when I looked, a month or so ago. The US has really tanked in the last month or so, it feels like. So it feels like that's more global now. That's by number of downgrades. But actually, if you look at severity, so if you take into account the size of those downgrades, it still doesn't look like we're nearly at a level that we've sort of troughed in many markets before. So I think that's the risk, is that you have more severity of downgrades for, quite a few more months before you reach that sort of worst point of economic pain. And just the UK political situation is not helpful. I think the outflows from UK equities are, the worst, I guess, we've seen in some time. I think sentiment towards the UK has been pretty bad since Brexit, but particularly this year. And I think that's the challenge, is that the UK looks really cheap versus other regions. I think there's lots of reasons for us to be optimistic that, you know, that recovers, but that sentiment against the UK is just a bit of an unknown for me.
Right. Okay. And just finally, there was one company that you own, LBG Media, etc., which I did notice the CEO buying 900,000 shares this morning. How do you interpret when you get a lot? I mean, I think this is like nearly £500,000, so it wasn't an insignificant purchase. How do you interpret that in terms of just broadly, and for obviously, you know, LBG, because it trades on about 7 times PER.
Yeah. So Solly, he's the CEO, you know, the co-founders of the business are big shareholders. Yeah. But always a good sign for us, we would say, when, you know, they have the belief that actually this is a good buying opportunity, you know, that he wants to add to his shareholding here, essentially. So in general, we would take it as a good thing. So LBG is sort of better known by many people for its brands, which the main one is Lad Bible.
Yeah. Youth orientation, digitized digital advertising, isn't it?
They absolutely own that audience. You know, that sort of 18 to 30-ish year olds. They have really good relationships with all the social media platforms. They do a lot of direct brand content creation though. So for instance, like the British Army is one of their big customers in direct business. You know, they create all their marketing and advertising. So I think it's actually a better quality business than people often perceive. The challenge they've had is, look, that in their indirect business, they're absolutely growing volumes really strongly, but, you know, advertising pricing, unfortunately, has been really weak this year. So it's a little bit like they're running on a treadmill going backwards. You know, they're doing great underlying, but if your pricing goes against you, that's a short-term hit. They're doing lots of operational stuff to offset that. So they're doing short format videos. But yeah, they absolutely have cyclical elements. But no, I was really pleased this morning to see that sort of Solly had put some more money behind his belief.
And what point does it get to where I mean, I think he owns, I didn't quite remember, but I think he owns about 40% now or something like that of the actual company, or it's a big chunk anyway. What point does it become where you think actually the guy's going to take it private?
Yeah, I don't think he is. I think they absolutely, you know, this thing only listed, you know, a year ago.
Yeah,
I think they absolutely want to be a listed business. I think he's trying to sort of just signal his confidence in the business, but you're right. I mean, it is one of the sort of smaller free floats. So because of management and also the sort of supporters they had of the business pre-IPO, you know, actually, you know, we take it as a good thing. So when we see companies listing, we need to have enough good liquidity in shares. But you know, we take it as a positive that these believers in the businesses, whether they be the founders, the backers, have the conviction that they want to continue their ownership. You're one of the bigger ones that we are always nervous of at IPOs, which we obviously haven't really seen in the last year, but it's where you have some private equity business want to list the company and want to sell out every share to begin with. You know, that's a big warning signal to us.
Yeah, okay. All right, but brilliant. Well, thanks very much, Abby, for excellent insights. And if anybody wants to sort of invest in your funds in Aberdeen, how best to go about it? Is it through their IFA or website, or how do you do it?
Yeah, so our funds are available on sort of all the major platforms. Hopefully all of your IFAs are well aware of it. So within our team, we run our UK small and mid-cap funds. We've also got 2 investment trusts. And we also run European small cap, global small cap, and global mid-cap funds. So hopefully something for everyone.
Yeah, brilliant. Well, as I say, I mean, I'd highlight to investors, you've got a fabulous mix of sort of like lots of GARP stocks, actually, with good growth, which are trading on value multiples. So if you want a bit of diversification across a number of sectors, which are with a lot of companies there that can grow and hopefully be able to make significant capital appreciation over the medium to long term, I would point investors have a good close look at those portfolios. So thanks very much, Abby, and look forward in chatting again in about 6 months' time.
Yeah, thanks for having me.